This brings us to ask the question as to why is this happening now? And the exit environment is the reason. The surge in the continuation vehicle activity reflects broader challenges in the private equity exit environment. Several factors have converged to make traditional exits less attractive. First and foremost, the IPO market, while showing signs of recovery, remain very selective. The public market window that opened briefly has not provided consistent exit opportunity. PE firms need to generate distributions at scale. Many portfolio companies that might have been IPO candidates in previous cycles remain in private hands. The second factor being that strategic buyers have become more disciplined. Corporate acquirers are conducting more rigorous due diligence, taking longer to close transactions, and in many cases offering valuations below the private equity firm's expectations. The valuation gap between the buyer and the seller expectations has proven difficult to bridge. So, in this environment, continuation vehicles offer a third path. They allow the PE firms to generate liquidity without accepting what they consider to be inadequate valuations. The implicit bet out here is that patience will be rewarded, and that holding an asset for additional years will ultimately generate superior returns compared to selling today. Next, let's try and understand the economics that is driving this kind of adoption. For private equity managers, continuation vehicles represent compelling economics beyond simply holding onto promising assets. Now, these transactions generate additional management fees on assets that might otherwise have been sold. They also preserve the potential for future performance fee if the company continues to appreciate. Consider the alternative. A PE firm sells a company to a strategic buyer or another financial sponsor. The transaction closes, fees end, and the firm's relationship with that asset terminates. With a continuation vehicle, the firm continues earning management fees on the same asset potentially for several more years. If a company is eventually sold at a higher valuation, the firm captures additional performance fees as well. Now, this economic reality has not been lost on industry participants. EQT, the Swedish private equity firm, has signaled its intention to begin using continuation vehicles specifically to generate additional fees on existing holdings. Other firms that have historically avoided these structures are also reconsidering their positions. And this brings us to a very important factor within this discussion, and that is the conflict of interest question. The growth of the continuation vehicles has intensified the debate about the potential conflicts of interest inherent in this kind of structure.